Morning guys, Joel Frank here, market analyst for YouTrading, and this is the midweek market update. So let's jump straight into it, starting off by taking a look at the S&P 500 as we always do. You can see that pretty much since the beginning of last week, which is when we hit these fresh record highs just below 4,550 in the S&P 500, we've been trading with a negative bias. We've even kind of formed this short-term bearish trend channel. And now the index is, I mean, this is pre-market trade now, so but the futures are trading below 4,450. So that's a 100-point pullback. We've pretty much dropped all the way back to the 50 DMA. Now, in the past, I've said this a million times. If you guys have been watching my videos, you'll know this. In the past, the 50 DMA has been a buying opportunity time and time again. I mean, there was one on the 19th of August. There was one on the 19th of July. It's almost like it happens every month. Here's one, 19th of May, and another one a couple of days before it, 13th of May. And then, look, it just keeps going, keeps going. The 50 DMA, time and time again, is an area where people like to buy the dip. Is that going to be the case again? I mean, history says probably. History does say probably. Why would we break lower? Well, I mean, there's a lot of things that could potentially, further setbacks to do with the pandemic, potentially a new variant that is, the vaccines are less effective towards, or concerns about global growth, or concerns about monetary policy being tightened too quickly. To be fair, I would say that there is a risk that we're going to break below this 50 DMA this time, and perhaps even extend lower towards this 19th of August low, because it looks likely that in the coming months the Fed is going to press ahead with winding down or beginning the winding down of its QE program, and it looks likely that they're going to do that regardless. Maybe not regardless, but it looks likely that they're going to do that despite a slowdown in the US economy. Now, if this slowdown in the US economy proves worse than expected, or a bigger slowdown in the US economy proves bigger than expected, then I think that, coupled with the Fed tightening monetary policy anyway, is going to be a stock negative event. So you could potentially see a bit of a pullback. In the long run, though, I still think equity market's going to be supported. So I mean, I would, as a long-term investor, investing for my retirement and later life, I will continue to be buying these equity markets at sort of whatever level they're trading at, just steadily buying. But that's just me, because when it comes down to it, FOMC policy is going to stay relatively accommodative for the foreseeable future, and it looks as though, okay, the US economy might be slowing, but it's not going to go into a recession anytime soon. So that's my thesis for stocks. Let's look at the dollar really quickly. You can see it's pulled back a little bit since we had the CPI numbers for August. They were a little bit weaker than expected yesterday, and so we've dropped back from just above 92.50 to just below 92.50. If the CPI numbers had been higher than expected, well, then perhaps we could have broken out of this range, because as you can see here, around this 92.80 area, that's been a good area of support, and then it turned into resistance on multiple occasions. But we didn't get that, so we'll just have to wait for now. And the dollar is probably just going to be range bound now. Can't select that arrow. But yeah, the dollar's probably going to be range bound now until next week's FOMC meeting, which is really going to be the next big thing for the dollar, and how hawkish they are with regards to their QE, with regards to their guidance on interest rates, with regards to their view of the economy. All those things are going to be the key focuses. So yeah, things probably just going to be range bound around the 92.50 mark until then. Gold. You can see it's picked up. It was testing the lows of this recent range around 1,780. That's been a good area of support over the last couple of weeks, as you can see here. We were testing that, but then a bit of relief from that weaker than expected inflation, which resulted in a weaker dollar, which has helped gold move to test these areas of resistance here around the psychologically important 1800 level. And a bit like the dollar, it probably seems likely that gold is going to be range bound within recent ranges, so not getting much more above 1,820 or 1,830, and not going much below 1,780, at least until the FOMC meeting next week. Crude oil, got some different things to talk about, because it's been largely driven by supply side factors recently, to be honest. As you can see, it was gradually edging higher, and that kind of move higher has accelerated in recent days. There's been, and as you can see, we've kind of had a bit of a breakout above this area of resistance from earlier on in the month. That was, you know, that key $70 level. Well, now we're pushing on from that. We're at 71.50. So a bit of technical buying probably in play. From a technical perspective, the next area you want to target is this 73 sort of 70 area, which is that high from late July. In terms of the fundamentals though, like I said, there's been a lot of focus on supply side dynamics because you've had this horrific Hurricane Ida, which wreaked havoc in the south of the US and has led to severe disruptions in output in the Gulf of Mexico, which has been recovering less quickly than I think the markets expected, which has been why these gains have accelerated in recent days. And there's another tropical storm at the moment which is further hampering the recovery of the crude oil production in the Gulf of Mexico. Tropical Storm Nicholas, or it might even be a hurricane. It's not as powerful as the last one, but it's still a problem. And you know, last night API inventory data was out and showed a much bigger than expected draw, which is to be expected if oil production is going to be lower than expected in the next couple of weeks because of these disruptions. You're going to get bigger than expected draws, which should be price supportive. So as long as focus doesn't go on to demand side weakness, and there is some demand side weakness. We had Chinese retail sales industrial data out last night. Wasn't great. We've got US industrial production data out today. Might be not great. I mean, we're going to have to wait and see. But yeah, as long as the focus doesn't go to weak global economic data and it stays on supply side, well then we can probably hit this this level here. But yeah, guys, hope you enjoyed the video, and I'll see you all in the next one.